Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Richard Tomlinson, CIO of the Local Pension Partnership Investments. That's a bit of a mouthful. Let's just call it LPPI from now on. Welcome to the show, Richard.
Thank you, Charlotte. Great to be here.
Do tell us, what is your news story of the week?
Well, one that caught my eye, and I think has caught quite a few other people's eyes as well, given the coverage it's got, is the decision or the proposed decision by Kensington and Chelsea to essentially cut, or the LGPS scheme of Kensington and Chelsea, I should say, to potentially cut employer contributions to zero for next year, for this coming year.
Yes, that's quite a story. I mean, I want to ask you, why do we think that's of interest to professional investors? But it seems like a kind of redundant question almost. So why do we think it's of interest?
Well, I think it's interesting because it cuts across a whole series of things which, at LPPI we've been engaged in, and it's right in the public domain. It's really part of policy discussion at this point in time. And there's a few things going on there. There's obviously central government has been looking very closely at pensions for a little while, and we're in the middle of a consultation, certainly pointing at the LGPS and broader the pensions landscape. So that what's taking place here is relevant because of that broader backdrop. But it's also important because I think there's a broader dialogue around affordability of pensions long run, how that comes together, and in terms of the funding at local authorities and councils and how that's coming together. So it's coming together in a whole series of things. Another thing that we've done as LPPI, we've put out a paper last week talking about the issue and thinking about how investment asset allocation can impact long-term affordability of pensions, thinking about how those things come together.
Yeah, and I mean, you might think at first glance when you see that headline, you think, oh no, it's a council that's so cash-strapped and so much on the point of bankruptcy that they can't afford their contributions to their pension scheme anymore. But actually, that's not at all the case. They are exceptionally well funded, aren't they, Richard? Is it 207%, I think it mentions in the article?
Yeah, and I think exactly. It's interesting because it's a case. It's not coming from a place of weakness. It's coming from a place of strength from the funding position of the pension scheme itself. So the pension scheme is well funded. However, the one thing to think about as with any defined benefit pension scheme, it's the key question, which we'll probably talk about a little bit more in a moment, is at what discount rate? Because there is obviously a lot of debate around what discount rate is used to value the liabilities, and the LGPS uses a different methodology to, I'm not going to say all other UK defined benefit pension schemes, but certainly almost all other. So there is a little bit of nuance there, but ultimately, in the context of the LGPS, the scheme is very well funded, so is able to have more scope for managing contribution levels for employers.
So could you give us, because I was talking about this when we were doing a panel together the other week, and I was saying, with all of UK pensions, if you were to start, you wouldn't start from where you are now. But perhaps the one that you really wouldn't start where you are now is the LGPS. And I talk about this wonderful slide that sits on the PLSA website that tries to describe all the government agencies. And it honestly looks like somebody took magic mushrooms before they put this slide together because it's so many different colors and different arrows. So I know there's kind of competing forces on how it's regulated. And then there has been lots of debate as well as whether how you value these pensions, and they did escape the very draconian valuation that private sector pensions got. So what's kind of difference in discount rates are we talking there?
So the discount rate generally used across the LGPS, I said the rules give funds and the actuaries far more scope than is allowed in the for pretty much everybody else corporate DB sector. So most schemes use what you might call an expected return on the portfolio adjusted for prudence type approach. So you generally have a discount rate that's probably a 4 or 5% type numbers. And critically, it's been of that order of magnitude for a number of years. So it hasn't gone up or down as long-term bond yields have moved. So it hasn't been whipsawed in the way that discount rates for corporate DB and others have been. So it's quite a different valuation framework and way of valuing the liabilities. And that then has a feed-through impact on the asset allocation, whether things like direct liability hedging make sense, and how you might think about contribution levels. It's in reality, it's a more flexible system, and I think you used the word draconian. It's just less rigid, so there is more scope to be able to focus on delivering the aims, the long-term aims for the stakeholders, and doing that affordably within and managing contribution levels in an appropriate way.
So even though, I mean, they've had a more benign discount rate environment, I mean, arguably you could say closed is sort of caught up to those sort of levels-ish now. Kensington Chelsea is not alone in using that discount rate, so they must have, to have this incredibly positive funding position, have done something differently from an investment perspective to be in that position today. Can we talk a bit about what have they done differently to other either pools or other individual partner funds of the LGPS? Yeah,
I think the one thing, if you just step back a minute for the whole of the LGPS has a relatively high weight to growth assets and specifically listed equities. So whenever anybody looks at the LGPS from the outside looking in, they go, "Wow, there's quite a lot of equity risk in there." And Kensington Chelsea's at the upper end of that. If you look at this data that's disclosed, it's in the 80% plus type numbers, depending on how you think about private equity, but it's 80-85% in equity. So it's got a high equity weighting relative to the broad LGPS, which has a reasonable, there's a high weighting to equity risk anyway, compared to other pension schemes. So by virtue of having had a high exposure to equities looking backwards, the portfolio's performed well. And the impact on the forward-looking is the discount rate. I have to say, I had a quick look. I don't know what the discount rate they're using is, but it's going to be at the higher end of things, because you have a high equity weighting, which means the actuary is almost certainly going to say your forward-looking portfolio has got a higher expected return than if you owned a load of gilts, for example. So there's the combination of those two, and that then has given the scheme the scope to manage contribution rates for employers. However, what we found quite interesting is when there's various scatter charts you can look at, and there's one that's produced by PERC, and we've done the same internal analysis that shows you expected volatility versus backward-looking return. I think it's the last 5 years. And if you look at that, you see a big blob of the bulk of the LGPS funds in a zone, and then 4 funds stand out as different outside that blob. One of them is Kensington Chelsea, with higher levels of return and higher levels of expected volatility and risk. And there's 3 others that stand out with a more moderate level of return, a slightly lower level of return, I should say, it's only slightly lower, but with noticeably different risk level, let's say lower. Let's just say those 3 funds are funds I'm very familiar with. They're the 3 in the LPPI stable.
Are they? That's so nicely teed up, Richard.
It's as if I'm prepared.
As if you're prepared to say how wonderful you are, and you have the chart to prove it. But I mean, all of that makes sense, and we've all lived through the great galloping up of equities. First of all, driven by the fact that bond yields were so low, so people kind of went into equities almost out of default. Now we've seen this utterly fascinating period where not only have we seen interest rates recover, but we've seen a reversal in the usual relationship and volatility between bonds and equities, where equities have looked like stable Mary, if I can call it that, and bonds have been, volatile and going up and down all over the place. So that contributes obviously to why Kensington and Chelsea have done so well. But there is always a danger, isn't there, that we have that might not persist, and that things could change, and that equities might one day actually collapse, although it seems impossible. But usually when it seems impossible is usually when it's going to happen. So do you feel that there's a lot riding on that Kensington and Chelsea sort of portfolio design, and it's maybe a bit more risk than you personally would be comfortable with? Or
yeah, the way I'd frame that is that it's the strategic asset allocation sits with the LGPS funds themselves. As LPPI, we give advice to our partner funds, and we have done since our inception in 2016, which is different to the rest of the LGPS pools, but we have been providing that advice. And I think that it comes down to risk appetite, of how much risk you want to run, and balancing the risk between running risk in the investment portfolio and then and then running, or potentially how you want to think about your funding strategy. So the two come together. They're not separate items. They need to be joined together. And to be clear, the LGPS, as we said earlier, has a lot more flexibility than other pension schemes to manage contribution levels. And the core aim of the LGPS, sometimes it just sometimes gets forgotten at times, is to pay all pensions they fall due, and the wording I would use is affordably and efficiently. So that means keeping contribution levels and being very mindful of that, and keeping them stable and contained. So having an equity heavy portfolio in the long run is probably a very sensible way to manage long run affordability. And at this point in time, Kensington, you could look to Kensington and Chelsea. They've proved that worked. You've had a good run in equities, and they've proved a very high fund level. How that plays out in forward is a different question. My personal view, I'd probably rather have a slightly more diversity in the portfolio. I'm absolutely not advocating for owning a big pile of gilts, because I think that has other implications, but a broader mix of assets, so not quite so equity heavy, would be my where it's certainly where LPPI and where we're guiding our clients towards. And the reasons for that is multiple fold. I say the LGPS has an ability to have a broad asset allocation, let's say, so you can diversify into other areas with high returns, maybe not quite potentially as high as listed equities, but with more balance. So I'm thinking areas such as private credit, I'm thinking areas such as direct infrastructure, I'm thinking and other things. So it's still going to have a heavy weight in equities, and part of the reason I'm quite mindful about high quality fixed income, that whilst yields are higher than they have been for a long time, you're still talking nominal yields of, let's say 5%, 4.5%, depending where gilts are, where you're on the curve at most. And are we living in an environment now where you have negative correlation of equities and equities and fixed income and bonds? That's pivots on a view on inflation. So in inflationary times, they tend to be more positively correlated. So I suppose in a roundabout way, what I'm saying is that I think you want a more diverse portfolio, but not necessarily loading up on high quality fixed income.
Okay, not necessarily, or necessarily loading up on
Not necessarily. So our portfolios, we have a very low weight to traditional fixed income.
And by traditionally, you mean corporate investment grade?
Yes, exactly.
Okay.
Okay.
And gilts. Well, I mean, the gilts, I can understand that you don't really want an awful lot in there, especially given that you are open and you've got contributions still coming in. There isn't the same conundrum going on as there is within the closed corporate DB schemes. So that does make perfect sense. But let's touch on a bit more. I think there are some other differences between Kensington and Chelsea and other LGPS funds outside of the sort of the way the portfolio is designed in terms of asset allocation. Have they taken a different attitude to that theme that's obsessing so much of us in the LGPS, sustainable investing too?
Potentially. As I say, I'll choose my words very carefully here. If you take a quick look at what they're owning, it is very, very equity heavy and has a certain flavour to it. And I think that means the asset allocation makes sense. I think if you look across the broad LGPS, and then you think about that, it's Bridges Ventures spectrum of capital type perspective, from all the way through from a pure financial investor right the way through to impact with a big I or philanthropic, and where you sit on that spectrum. I think the LGPS has taken a sort of broader view on where different funds sit on that spectrum. So I would suggest that Kensington and Chelsea is sitting nearer that pure financial investor perspective. Not all LGPS funds, they're probably slightly further along, whether they're going through integrated ESG, sustainable. So it's a broad church of what the goals. But as I say, the LGPS gives single funds scope to pick where they sit on that spectrum at this point in time. Who knows if that changes? So that's clearly where that Kensington and Chelsea have chosen to sit. Other funds maybe slightly further along, and that's very much a sovereign choice for the funds themselves to guide to. I
mean, I know I talk a lot about sustainable investment, but I can see both sides of the argument in that obviously we've got going through a bit of a backlash against sustainable investment at the moment. And you could, I think, quite reasonably argue, and policymakers have argued, that it's not necessarily the job of investors to change the world, it's the job of policymakers to change the world. It's the job of policymakers to legislate and regulate in a way that makes it easier for investors to change the world. And when you're leaving kind of a lot on the shoulders of investors to sort of control and change company behavior, whilst that's useful and helpful, you do need the two things working hand in glove together. So I can understand that attitude. But then if I think about the fact that pensions is such a long-term game, especially for an open DB scheme. We're talking sort of 30, 40, 50, 60 years. You do have to worry, don't you, about what your workers today, particularly your younger workers today, what kind of world they're going to retire into and how you future-proof that. How do you think about those sort of competing desires? And I know that that's kind of like the heart of investment, right? That sort of balancing the short with the long term and trying to figure out which trend is going to be the winning one over time. That's why investment is so utterly fascinating, I think. Because nobody knows the answer. That's what makes it so interesting.
No, the future's unknowable. Anyone that tells you otherwise is either a fool or they're lying, basically. But I think what you can have is you might have some clues. And I think if we start off with what does sustainability mean? It's one of these terms that gets thrown around all the time. Are you sustainable? What does that mean? You've got to write down what you mean by that or articulate it. And I think if you look closely at what I think the rules and the regs the LGPS currently says, there is a steer towards sustainability, but it really is more saying sustainability from a financial point of view. Your core goal is to invest the portfolio in a financially sustainable way, so you can pay pensions in the long run. Now, there is obviously a version of sustainability which talks much more broadly about global sustainability or societal or environmental sustainability, and that's in addition to. But the key for me is thinking about it. The bulk of the capital we invest, you're looking at it from a financial stability, a sustainability lens, and thinking through you're looking at the E, S, and G. So you use those acronyms through a financial risk lens and saying which ones of these are material to the financial sustainability of the portfolio or our ability to pay pensions and for the assets in the portfolio. And I think that's how I join the two up. And what I would point to is that the LGPS is, what would you describe it as? As a public sector scheme, quasi-sovereign, whatever words you want to use. So there are elements of which I would put under the license to operate type perspective. You cannot divorce yourself from that broader responsibility. It's taxpayer money, ultimately, or taxpayer contributions and other things. So I think there's an element of which you need to be very clear-eyed and talk to elements which you might be talking about, call it impact with a small I. Maybe a big I, depending on how you frame it. But whether that's local housing or other infrastructure in the UK and other targeted investments. But I think what you do need to do is to be crystal clear about, as you underwrite an asset in the different parts of your portfolio, be really clear on the aims for that. This bit of the portfolio, for example, is to pay pensions they fall due, is more about financial sustainability. This bit is targeted on local impact because we're say in the area of the fund, and the financial component is essentially subordinated to the local impact piece, but the financial return has to be good enough, if that makes sense. You can trade the two off, but being very clear on that and not muddling the two up. Because I fear that muddling the two up, you can end up in a situation like maybe happening on the other side of the Atlantic, where everything's getting kicked back because the people haven't been crystal clear on what the purpose of the different elements is.
I get that, and I get that why that logic appeals. But just to sort of play devil's advocate there, is that going to go back to my point? You're investing over such long timelines. Can you really kind of portion out which bit of the portfolio is financial return and which bit? I get that you want to have, say, maybe the impact fund. I can understand in that this is a particular parcel of money which is going to serve a particular purpose, and the financial return is ancillary to that purpose. I get that. But I wonder if we look back at sort of the bulk of the portfolio, whether it's equities or private debt. So I think you can argue it either way, that, we're looking at the financial return on that. And to sort of pick up on a point discussion I had at the first episode with Dan Mikulskis about whether you should worry about concentration risk. If you're in passive equities, and let's say you invest in passive equities for 40 years, in theory, in a way, you should have to do nothing at all because the market will evolve. It will chuck out those companies that that end up, say, maybe as stranded assets, or don't get to net zero, or do get to net zero too quickly and then end up having too low growth. Can you be almost like a sort of a more of a sort of a passive sit back with passive equities and just wait for the market to work it out? Is that a viable way forward in this?
There are some investors that would argue that it's not their job to engage. It's not their job to do these things. It's government's job. It's more like a kind of Milton Friedman type argument. And you own the market in a way, and it will sort itself out. And I don't I do get that argument. However, I'd frame it slightly differently. Where I'd come from is that certainly within LPPI, we view ourselves as, the phrase I'll use is, stewards of our clients' capital and reputations. And that then cuts across this whole stewardship piece. So all the capital we look after, we manage on behalf of our clients, we view ourselves as stewards. And part of that is investing for the long term to build capital to pay pensions they fall due in the future. Part of that is managing liquidity. A part of that is stewarding the assets and the capital well. So that's where you cut across some of these points. It's making sure that they are both financially sustainable, but it's then the reputational piece where it kicks in, that you do have to think more broadly about what you're investing in and why, and all of that. That's not to say that you have a moral or an ethical filter. You have to be mindful of that, but it is a case of being an overall steward of the capital and investing it with the long horizon. And it's a fair point that markets will punish those that aren't moving the direction, and that is why markets in some ways are so beautiful and wonderful, yet brutal as well, if that makes sense.
Yeah, it's the longest continuous mass psychological experiment that human beings have ever run. So on that point, where does that leave you in terms of your attitude towards stewardship and thinking about how you I mentioned earlier on that there is a debate, isn't there, about how much should financial investors have to do this, how much should policymakers do it. We're really obviously struggling for global leadership in terms of having global people coming together and agreeing concepts that should all be implemented across the world. Is systemic stewardship, this new sort of catchphrase, the idea of using your position to lobby for more effective stewardship, do you see that as something that falls within your edict, something that you want to pursue? Because to go back to the challenges around stewardship, you are very reliant on asset managers and resources and all the rest of it. And there's a question of how much cajoling you can actually do without a stick to beat people.
No, absolutely. And I think just to add one element to that, there are very different routes to good stewardship in different areas of the portfolio. The way you would steward a direct infrastructure asset where you might have someone on the board or similar, it's very different to what you might do with a building that you own versus a listed equity. So if you just think about those different cases in listed markets, unfortunately, we're not big enough to really be able to drive outcomes for very large listed companies. Yeah, maybe Norges Bank are, one or two others, very, very big scale investors. We're not. So, but even for the very largest investors, they tend to be part of broader collaborations to engage on that point. So to me, it's about having that engagement with corporates, but really being part of a broader, we call it network or a grouping, to focus on key themes. But what I'd say is on that front, you can't boil the ocean. You need to pick off a few key themes that you're able to look at each point in time, otherwise, and try and just talk about those. Whereas if you rotate through the portfolio, there are some areas where, as a steward of the portfolio, of the capital, of the asset, you can have very real additionality that you can point to, and you can say, we did that, and you can evidence it to your stakeholders. Whether that's an easy, tangible example, if you own second or third tier office buildings that currently you may not be able to, they may not be very desirable, they may be empty because if they're in a decent location, but then they're not in line with modern practices. If you invest to upgrade them to more sustainable characteristics, where they bring it in line with net zero, etc., then you may find you can uplift the rent and you can fill the building. So you can be very clear. There's clear additionality that we did A, B, C, and these are the outcomes, and that can align both with a net zero pathway and improving the quality of the asset, and improving the financial sustainability of the asset for your stakeholders. And again, if you own an infrastructure asset and you in the private markets and you have a material stake, and you may well have some control and be able to influence things. So to me, good stewardship is linking it back to the goals, but being quite precise to the different asset classes over what makes sense and what doesn't in that context.
So the final question to you, Richard, is sort of touch back on something that we were talking about at the event at the end of January. We spent a lot of time talking about consolidation. How do you think sort of government proposals around LGPS consolidation, what kind of impact is that going to have? To go back also to the news story that we started with somebody like Kensington and Chelsea having a 207% funding levels, because the logical conclusion on that is actually, they wouldn't really have been able, well, maybe they would have been able to do it, but how to sort of bringing more of the investment within a pool and leaving strategic decisions to partner funds, would that reshape what Kensington Chelsea have been able to do? Does that have implications for other LGPS in terms of how much control they have?
Yeah, it's interesting. It's a hotly debated topic. I think there's an awful lot of not confusion's the wrong word, but the government's going in a certain direction. I don't know where they will land. They are clearly pushing towards consolidation. I think the funds themselves have concerns that some of the things they're used to being able to do, they'll be less able to do in the future should the government push through what is proposed. And let's be honest, LPPI is largely in line with a lot of things the government is pushing towards. So our clients have experienced what the government is pointing towards potentially as that. And our experience is our clients are very happy and don't feel they can't execute their aims. That being too imprecise, but if you look at the performance tables and returns over the last 5-10 years, we're not that far away from Kensington and Chelsea. So it's a case of with a much broader, more diversified asset allocation. So our clients have been able to do similar things to that. And I'd say that in the case of Kensington and Chelsea, they wouldn't have been able to. I don't know where it goes. They may not have been able to do exactly what they've done. And I know they were certainly pushing back, but could they have had a broadly similar asset allocation? Absolutely. So if you look at what the government is proposing, they are proposing one version is to leave the asset allocation with the funds, and this idea that the funds will lose local accountability from pooling, I don't really see it that way. I don't see our clients having any loss of local accountability due to essentially us acting as their fiduciary and implementing their portfolio. And we've designed a structure to be sympathetic to that. The real local accountability comes from setting contributions and owning the overall risk profile, which our clients have done, and I don't see that changing. So I think it's one of those ones where it is debatable. It is change, but I'm not sure it's quite as big a change as is being thought about in some ways. But I do think this Kensington and Chelsea, the proposal to change the contribution rates is interesting. It's meaningful. I don't quite know how it plays out. I don't know how government will feel about it and how they may respond. We'll see. But it does feel like an interesting move in the game of 3D chess that we're all playing at this point in time.
Whilst designing charts and dropping magic mushrooms, yeah. I think that's a great point in which to end our discussion. I just want to say thank you so much, Richard, for being a guest on the show. And thank you for sharing that wonderful news story of the week, which is certainly going to spark plenty of discussion, I think, within the industry. And it has been a great topic for us to debate. Listeners, make sure you hit the subscribe button to never miss an episode. And please do interact with us as much as you can. Do comment on the podcast and do engage with the poll if you're listening on Spotify. Thank you for listening.